Welcome back to our ongoing exploration of Forex trading. Today we're diving into Lesson 7 of Chapter 6, Exploring Free Margin in Forex Trading. Now you might be wondering, what exactly is free margin? Well, it's the funds in a trader's account that are available for opening new trades or sustaining existing ones beyond the used margin. Throughout this video, we'll be taking a closer look at the concept of free margin, how it's calculated, and its role in trading. We'll delve into the significance of the used margin, which is the portion of equity locked as security for open positions, and its impact on free margin. Additionally, we'll highlight how free margin serves as a safeguard against margin calls, and underscore its importance for effective account management, risk assessment, and strategic trading. So, buckle up as we delve into the world of free margin and its crucial role in Forex trading. We begin our journey with the definition of free margin. Picture this. You're at a poker table, and you've got a stack of chips in front of you. Some of those chips are committed to the pot, they're in the game, they're at risk. But there's a portion of your stack that's still free, not yet in play, ready to be put to work when you see the right opportunity. In the world of Forex trading, this uncommitted portion of your stack is what we call free margin. Free margin, in essence, is the money in a trader's account that is available and ready for opening new trades or sustaining the ones already open. It's the portion of your funds that isn't yet committed, isn't yet at risk, isn't yet locked up as security against your open positions. It's your buffer, your safety net, your pool of potential. Think of it as your financial breathing room. It's the money you can use to enter new trades when you spot a profitable opportunity. It's also the money that can absorb the losses from your current trades, keeping you in the game even when things don't go as planned. But here's where it gets interesting. Your free margin isn't just sitting there, static and unchanging. It's dynamic, constantly fluctuating based on the performance of your open trades. When your trades are profitable, your free margin increases. When your trades are losing, your free margin decreases. So, in a nutshell, free margin is the funds you have available for trading, beyond what you've already committed to your open positions. It's a key component of your trading strategy, your risk management, and ultimately, your trading success. Understanding free margin isn't just about knowing what it is. It's about understanding how it works, how it changes, and how it impacts your trading decisions. It's about understanding its role in your overall trading strategy and how to use it to your advantage. Understanding free margin is the first step in mastering Forex trading. Now that we have defined free margin, let's delve deeper into it. Just like the deep end of a pool, where the water is denser, the concept of free margin is a bit more involved, but it's not something you cannot handle. In its simplest form, free margin is the equity in your trading account minus the margin that's currently being used for open positions. You could say it's like your trading account's breathing room. Let's illustrate this with an everyday scenario. Imagine you're out shopping with a budget of $100. You've already spent $50 on groceries, which leaves you with $50 free to spend on anything else. In this analogy, your total budget is like your account equity. The money spent on groceries is your used margin, and the remaining money is your free margin. It's the extra cash you have to spend without going over your budget. Now translate this to the world of Forex trading. Your account equity is your total budget, the margin used for open positions is like the money you've already spent, and the free margin, well, that's your remaining budget. It's the capital you have available to open new trades, or to absorb any losses from your current positions. Remember, the free margin fluctuates as the market moves. If your open positions are profitable, your equity increases, and so does your free margin. But if the market turns against your open positions, your equity decreases, and your free margin shrinks accordingly. To sum up, free margin is the safety net that allows you to keep trading. It's the buffer that enables you to weather the storms of the Forex market and live to trade another day. It's an essential element of risk management and a key indicator of your account's health. So keep a keen eye on it and trade wisely. We've talked about free margin, but let's not forget about used margin. Now you might be wondering, what exactly is used margin? In the simplest terms, used margin is the portion of your account equity that's set aside, locked if you will, as a security deposit for your open trades. It's like a collateral that your broker holds onto while you're engaged in active trading. This used margin isn't something that's just arbitrarily decided upon. No, it's directly linked to the size of your open positions. Larger the position, greater the used margin. And here's the kicker, as long as a position remains open, the used margin stays locked. It's only released back into your account when the position is closed. Now, how does this tie back to our topic of free margin? Well, remember when we said that free margin is essentially your account equity minus the used margin? Here's where the correlation comes into play. The more of your account equity that's locked up as used margin, the less free margin you have available. It's a seesaw balance, if you will. As one goes up, the other comes down. And this is where the role of used margin becomes crucial. It's not just a passive figure sitting on your account statement. It's an active player in your trading strategy. A high used margin means you have less free margin available to open new trades or absorb losses from existing ones. This can potentially limit your trading opportunities or, even worse, put you at risk of a margin call if the market doesn't swing in your favor. On the other hand, a lower used margin means more free margin, giving you a larger buffer to weather market fluctuations and take advantage of new trading opportunities. So, managing your used margin effectively becomes a key strategy in Forex trading. It's about finding that sweet spot where you're maximizing your trading potential while also maintaining a safety buffer. Used margin, therefore, plays a crucial role in determining your free margin. It's a delicate dance, but mastering it can make all the difference in your trading journey. Margin calls are a trader's worst nightmare, but there's a way to prevent them. Now let's delve into the critical role that free margin plays in preventing margin calls. Imagine you're in a boxing ring. Your free margin is like your stamina. It determines how long you can stay in the fight. When your stamina, or in this case your free margin, is depleted, you're in danger of a knockout, or what we call in Forex trading, a margin call. A margin call is when a broker demands that an investor deposits additional money or securities so that the margin account is brought up to the minimum maintenance margin. This happens when your open positions are moving against you, eroding your used margin and consequently your free margin. So, how does free margin work as a safeguard against this? Well, free margin is essentially your buffer, your safety net. It's the leeway you have before the broker steps in and says, "Hey, you need to deposit more funds or I'm closing your positions." The higher your free margin, the more cushion you have against potential losses. It's like having a robust insurance policy. If your open trades start to go south, your free margin can absorb those losses up to a point. The moment your free margin hits zero, you're in the danger zone for a margin call. But remember, free margin isn't just there to protect you from margin calls. It's also your opportunity to open new trades. It's like having extra fuel in your tank, allowing you to travel further or make a detour if you spot an interesting opportunity along the way. So, it's crucial to monitor your free margin closely. It's your ticket to ride the turbulent waves of the Forex market without getting wiped out by a margin call. Keep an eye on it, nurture it, protect it. Because when it comes to Forex trading, your free margin is more than just a number, it's your lifeline. In essence, free margin is your first line of defense against a margin call. Now let's get into the nitty-gritty of calculating free margin. Ever wonder how you can ascertain the amount of buffer you have at your disposal for new trades or to absorb losses? Well, buckle up, because we're about to break down the calculation of free margin for you. Free margin is calculated by subtracting your used margin from your total equity. It's as simple as that. But let's delve a little deeper to understand what these terms mean. Your equity is the total value of your trading account. It's the sum of your balance and your floating profit or loss. Your balance is the money you've deposited into your account, and your floating profit or loss is the unrealized gain or loss from your open trades. On the other hand, your used margin is the amount of money that's tied up in maintaining your open positions. It's the security deposit your broker requires to ensure you can cover any potential losses from your trades. So, if you subtract the used margin from your equity, you get your free margin. Let's illustrate this with an example. Imagine you have an equity of $5,000. Currently, you have $1,000 as used margin for your open positions. If you deduct your used margin from your equity, you get a free margin of $4,000. This is the amount you have available to open new positions or to sustain any potential losses. However, remember that your free margin isn't static. It fluctuates as your floating profit or loss changes with market movements. If your open trades are profitable, your equity increases, and so does your free margin. But if your open trades are losing, your equity and free margin decrease. So you see, calculating your free margin is a dynamic process that provides real-time insights into the financial health of your trading account. It's a critical metric that helps you gauge your risk exposure and make strategic trading decisions. Understanding how to calculate free margin can help you manage your trades more effectively. Finally, let's talk about why free margin is so important in Forex trading. The significance of free margin cannot be overstated. It's like a financial thermometer, gauging the health of your trading account. An ample amount of free margin suggests your account is in a healthy state, while a dwindling free margin indicates potential trouble. Free margin is a reflection of your account's equity that isn't locked up in current trades. It's the capital you can use to open new positions or sustain existing ones. A larger free margin allows you to take on more trades and potentially earn more profits. But let's not forget the risk side of the equation. Forex trading is inherently risky, and the free margin is your buffer against those risks. If your open positions start to turn against you, the free margin is the first line of defense that prevents a margin call. In essence, free margin is your trading account's safety net. It's the cushion that absorbs the shocks of the unpredictable Forex market. It's the indicator that tells you when to step on the gas and when to hit the brakes. Monitoring your free margin can guide your trading decisions. If your free margin is high, you might feel confident to open new positions. If it's low, you might want to close some positions or deposit more funds to boost your equity. The free margin can also help you in risk assessment. By keeping an eye on your free margin, you can gauge how much risk you're currently exposed to. It's a dynamic figure that changes with market movements, profits, and losses. In strategic trading, free margin is a key player. It allows you to plan your trades, manage your risks, and aim for sustainable profits. It's not just about how much you can earn, but also about how long you can stay in the game. Remember, the goal in Forex trading is not to make a quick buck, but to build a steady stream of income. And for that, you need to manage your free margin wisely. Keeping an eye on your free margin is a key part of successful Forex trading. That brings us to the end of Lesson 7 of Chapter 6. We've journeyed through the intriguing world of free margin in Forex trading. We kicked off by demystifying what free margin is, painting a clear picture of it as the available funds in a trader's account for opening new trades or sustaining existing ones beyond the used margin. We dove deeper into understanding free margin, revealing its essence as the equity in an account minus the margin being used for open positions. It represents a financial buffer, giving traders room to maneuver, whether for entering new trades or absorbing potential losses. We then turned the spotlight on the role of used margin in trading. We learned that used margin is the portion of equity locked as security for open positions and how it directly impacts the free margin. Our discussion ventured into the realm of preventing margin calls, emphasizing the function of free margin as a safeguard. It's the leeway before a broker demands additional funds or closes a position, a critical yardstick for traders to keep an eye on. We also decoded the method of calculating free margin. It's a simple subtraction, equity minus used margin. Yet it's a dynamic figure, constantly changing with the profit and loss from open trades. Finally, we underscored the significance of free margin in Forex trading. It's more than just a number. It's a vital tool for effective account management, risk assessment, and strategic trading. It's the pulse of a trader's financial health and the compass guiding their trading decisions. Understanding free margin is like having a secret key. It opens the door to a world of informed decisions, calculated risks, and strategic trades, turning the unpredictable Forex market into a navigable landscape. Thank you for joining us for this lesson. We encourage you to complete this lesson and look forward to seeing you in the next one. Understanding margin level in Forex trading.